Hi friends, when we book profits from stock market and wait for our next investing opportunity, the money remains idle and it gathers dust. Likewise, if we are waiting for market to correct so that we can buy on dips, what happens to our money? Again, it gathers dust. So this video is all about liquid ETFs that you can use to generate daily returns on this idle money. And more importantly, I will show you how exactly liquid ETFs like Grow Nifty One Day Rate liquid ETFs work exactly. With that, people who don't know me, my name is Rahul Jain. I am a full-time investor and a full-time content creator. Let's get this video cracking. Recently, I created this video where I explained why it is extremely important for investors to hold some money in the form of liquid assets so that whenever the market corrects, they can go ahead and buy the dip. Now let me give you a live example. Have a look at my screen and you will see a stock called REC Limited. Again, it's not a stock recommendation. I am using this as an example to drive home some important investing concepts. So what you see here is that from 22nd of April onwards, up until 3rd of June, the stock was in a massive bull run, right? The stock was going up, up, up. And if you wanted to take a fresh entry in this stock, it would have been extremely difficult because the stock was going up and up. Now comes 4th of June, you see this red candle here and the stock fell down by almost 25% in just one day. During the day, stock was massively crashing as the entire market was correcting that particular day. Now this is what is called a very meaningful correction. And if you want to take the opportunity to buy such dips, then what you need to do is you need to have liquid assets with you. And you could have handled this situation in two possible ways. Number one is that you have some money lying with you, idle money, let's say 5 lakh rupees, 1 lakh rupees, 10 lakh rupees, depending on your portfolio size. And as soon as there is a buy on dip on the stocks you like, on the indexes you like, you go ahead and use that money to buy the dip. But there are two problems in this approach. Problem number one is that we don't know when the market will correct. We don't know when the buy on dip opportunity will present itself. It might take a day, it might take weeks, it might take months, and it might take a year or even more. Because if you look at the Indian stock market in the last 1 year, Nifty has not given any meaningful corrections of, let's say, 8%, 10%. It has come down by maybe 2%, 3%, 4%, maximum 5%. So the point is that we do not know when the buy on dip opportunity is likely to present, and we might sit there, wait there for weeks and months, and the money that we have, the cash we have, it might lie idle, not earning anything for us. And then comes problem number two, which I have seen with many investors. What they do is that because the money is sitting idle and their friends are maybe earning good returns in, I don't know, in the SME IPOs or in the normal main board IPOs, what really happens with them is they get caught up in the FOMO and they say that, oh, my money is sitting idle, let me go ahead and put this money in the market. And this is the problem that I see many investors doing. Just because their money was lying idle, they go ahead and put it in the market, which is what you should not do. You should only put the money in the market if you are convinced about a particular stock that might give you good returns. Then comes the second way to handle these situations is that you don't let your money sit idle. What you do is you put that into liquid ETFs that I will speak about. And whenever there is a buy on dip opportunity, what you do is you withdraw this money from liquid ETF and put it into the stock market in the choice of your assets. Now, by putting this money into liquid ETFs, your money will not sit idle. It will generate daily returns and it might be somewhere between 5 to 7% annual return basis, and that too at a very, very low risk. So let me now explain liquid ETFs in details for you. There are two types of liquid ETFs. Number one is the growth NAV option and number two is dividend NAV option. Growth NAV option is, for example, Grow Nifty One Day Rate liquid ETF. Let me first explain the growth NAV option and then it will be very easy for me to explain the dividend option. So what happens in the growth NAV option liquid ETFs is that you, for example, have a fund manager here, right? And you have the, let's say, liquid fund here. So this is called liquid fund. Now this liquid fund is constructed of ETFs units. So these are called ETF units that trade on the stock exchange. So let's say unit number 1, 2, and so on. There are lots of ETF units. Now typically what happens is that this liquid fund, they go ahead and invest this money. So let us say that there is an investor here, for example, you and me, retail investor. So let's say this is retail investor 1 and retail investor 1 wants to invest, let's say, 100 rupees in this ETF. Okay. Now this total, let's say there is 100 rupees that you've got here as a liquid fund. What the fund manager will do is that this fund manager will go ahead and invest this 100 rupees. So let's go ahead and invest this 100 rupees in something called as overnight debt securities. Now who needs these overnight debts? It could be, for example, banks, right? banks need overnight debt to be able to manage their liquidity situation. It could be, for example, NBFCs, right? So there are many institutional buyers who need the overnight debt, and what they will do is they are ready to pay for this debt. Let's say 5 to 7% of interest rate can be earned on an yearly basis. So this is on a yearly basis, right? And that can be paid back to this fund, right? Now these banks and NBFCs that are taking this overnight debt, this is a risk free, very, very low risk is there, because these are, number one, these are overnight debt, right? Only for overnight they are given, and number two, these are backed by government collaterals many a times, right? So coming back to our example, let's say you invest 100 rupees, this fund invests 100 rupees in the overnight debt, and let's say it comes back to as 107 rupees as the return, including the return for 1 year. So this is yearly. After a year, you get 107 rupees back. Out of this 107 rupees, what will happen is the expense ratio of this ETF will get reduced. So let's say the expense ratio of this particular fund is, let's say, 50 paise, okay, for a year. So what will happen is the net profit here will become rupees 106.50. This 106.50 rupees comes back to this fund, and this money, which is additional 6 rupees 50 paise, gets added into the NAV of this particular ETF. That is why these are called growth NAV. Now look at this investor who put in 100 rupees here. After a year, his unit, let's say he got one unit, one ETF unit. This one ETF unit has now become what? How much? 106.50. So this investor now can go ahead and redeem this ETF and can get 6 rupees 50 paise as a profit. This is the concept of growth NAV. By the way, I forgot to speak about that these liquid funds are tracking something called as Nifty 1-day rate index, right? What is Nifty 1-day rate index? Nifty 1-day rate index is basically showing the returns generated by the overnight debt instruments, right? I hope that point is very, very clear. So these are the growth NAV options, very, very low risk because these are overnight debt, and the returns could be somewhere between 5 to 7% on an yearly basis, right? Depending on what the prevailing repo rates are. So this way, whenever the retail investor is having some money ideal, what they can do is they can purchase these ETF units, and whenever they need the money, they can instantly go and sell, redeem these ETFs and get some money back on their idle money. So on a daily basis, the NAV might go up slightly, and they can go ahead and anytime sell these ETFs on the exchange and can get some returns back on their pockets. So this is how, in nutshell, the growth NAV option works. So this is the example of what growth NAV option, right, in the liquid ETF. Now the second one is called dividend NAV option. In that, the only difference you will see is that, you know, the profit that came back 106.5 rupees, this profit will not get added into the NAV. What the fund will do is they will give you the fractional units. So they will give the fractional units of the ETF itself in lieu. So for example, here in this example, they will give you 0.06 units of the ETF, right? That you can go ahead and accumulate and redeem later. This, in my view, is slightly complicated. The dividend ones are slightly complicated. I really like the growth one where the NAV is increasing. So whenever you want to redeem your ETF, you go ahead and sell it on and you get your money back. I hope this entire concept of growth NAV and dividend NAV option is very, very clear to you. Now you will have lots of questions. So let me now go ahead and clarify 5 to 6 very, very important questions that you might have in your mind. So far, if you're liking this video, hit the like button. Also, you can consider subscribing to my YouTube member community if you want to improve your investing, because I do not have any paid courses right now. I do not run any shady Telegram channels or WhatsApp channels. The only way I teach is through my YouTube member community. The feedback has been excellent. I speak about stocks, mutual funds, ETFs, and various other assets that will help you make some good investing decisions. Now, coming back to most frequently asked questions on the liquid ETFs. Question number 1 is, what is the minimum amount to invest in the liquid ETFs? It could be as minimum as 500 rupees. So if your portfolio is, for example, larger or smaller, for example, if you have 10 lakh rupees of cash, you can use liquid ETFs to park that money. If you only have 10,000 rupees of cash lying idle, you can use liquid ETFs to park that money. So the minimum in the most liquid ETFs is only 500 rupees. Question number 2, Rahul, are there any entry loads or exit loads? In the majority of the liquid ETFs, you won't see any entry loads or exit loads, but please do check the scheme before you invest. Question number 3 is, Rahul, how do we identify which is a growth NAV option or dividend NAV option? This is very simple. You can do it in two ways. Number one is that if you look at the NAV of a fund and if you see that the NAV is going up over a period of time, that is a growth NAV. And if you see that the NAV is almost flat over a period of time, that means it's a dividend NAV option. The second way you can identify is that the dividend NAV option will always have word called IDCW in the scheme name itself, explaining that this is a dividend liquid ETF. Okay, Rahul, understood. Question number 4 is, which one out of these two is more tax efficient? So growth NAV liquid ETFs can result in higher after tax returns because taxes only apply once the units are sold. So they're more tax efficient. Also, growth NAV liquids do not have STT charges. Question number 5 is, can I lose money in liquid ETFs? It really depends on the buy price that you buy the liquid ETF. Please make sure that you do not buy a liquid ETF at a higher price than the indicative NAV. So indicative NAV is displayed by every liquid ETF. Go to their website, check the INAV, indicative NAV. So for example, if the INAV is 104 rupees 60 paise, you should not buy this liquid ETF at 106 or 107. You should only buy it at around 104.6050 at that level. Then you're not likely to lose any money, because the price at which the liquid ETF trades may be different than the INAV because of the demand and supply mismatch, and sometimes people end up buying the liquid ETF at a higher price than the INAV and hence may lose some money. But I'm pretty sure if you just stick to this INAV concept, you're not likely to lose money. Last question, which liquid ETF should I invest my money in? So I cannot give you any recommendations, but I can tell you 3 to 4 important parameters that you can use. Parameter number 1 that you need to check is the high volume. Make sure that any liquid ETF you're investing has got high volume so that whenever you want to sell it off, there is enough liquidity on the exchange. Number 2 is that lower expense ratio, of course, is better so that you don't pay a lot of money. And number 3 is the tracking error. As I explained, that Nifty one-day rate index is the tracking index, so please make sure that the tracking error is also low. So in this video, I've explained you a lot of details about the liquid ETFs, their usage, when to use them, and also some important questions and parameters about liquid ETFs. I hope you liked the video. If you did, hit the like button. Let me know in the comments a simple thank you. It will motivate me to come up with such content for you at zero cost. With that, I'll see you in my next video. Until then, keep rocking.